Welcome to Money Hangout once again. Every week we talk to you about something interesting or something you are curious about or anxious about and try and answer your mutual fund questions. We also try and help you understand mutual funds better. This is brought to you by Birla Sun Life Mutual Fund and Value Research. Today we are once again talking about a very basic concept, something which is very profound, which is very big, which was not possible 15-20 years ago, something which we hear about, uh, because when it comes to investing or the role of capital market, last month at the Berkshire Hathaway's annual general meeting, John Bogle, the father of indexing, father of index funds, so to say, uh, made a very unusual statement. When he was, of course, it was in a slightly different context than what we are talking about here. But what he said was that capital. He was asked in the context of if every investor starts indexing, then the markets will be dead. He said that yes, and the fallout of if the markets become inactive, if active investors are not there in the market, then it will become inactive, and if capital markets do not exist, then the ability of an investor or the need for an investor to turn a cash flow into a pile of capital and a pile of capital into a steady flow of cash, steady cash flow, will come to an end. And this is something which has become possible for investors in India ever since the modern mutual fund came into being. The open-end mutual fund started in the mid 90s, or has been gaining popularity, and it is still in its early days. And we understand that it provides access to the market, it provides diversification, it provides professional management. Yes, of course, it does all that. But I think something which has actually gone amiss, which has not been noticed as much, or people do not appreciate it, is that the smallest guy, the smallest investor, his ability to turn a small cash flow into a sizable capital, and a sizable capital can be invested to derive a periodic cash flow, that this ability has been democratized. Earlier it was not there. Before the advent of open-end funds, it was not possible for you to do it. So this is exactly what SIP does, and this is exactly what SWP does. Systematic investment plan, I think we have talked about often. There's far greater awareness. In fact, the awareness about SIP has come to such a level that the question that I got last month, few days back, actually sounds like a joke, but it was actually a real question. One person asked me that should he do an SIP or should he invest in mutual fund? And I had a hard time explaining that SIP is a method and you are investing in mutual funds anyway. But the point is that the heightened awareness created for SIP, so you know it, and it's important to appreciate that your ability to convert a small cash flow into a meaningful capital, that is what it empowers you with. SWP, your ability to convert a capital into a cash flow. All the people who have retired, or every person who has a fixed deposit which is expiring or which is maturing, and which means you have a capital and you are looking for an investment avenue, and that you are looking for an efficient investment avenue from which you can derive a cash flow. And broadly, most investor needs can actually broadly be classified into these two things: either you are accumulating or you are deriving income or deriving a part of the capital. So SIP and SWP, I think, needs to be appreciated for what it does. It will fulfill, investors have very simple needs. Investing for a goal, SIP can help you. Investing for retirement, investing for general well-being, or being financially well off, that money, till you have the cash flow, converting that into a capital, that is what it does. Then you need to derive that income when you don't have that income, so it can be derived from the capital. That is what SWP does. Then there is a third thing which is little different. It is a useful thing. Most investors have capital, and this is to be invested for the long term. This is not to be, you are not investing to derive the income from it. how do you go about investing it? Investing at one go is risky, is dangerous. If you are faced with a 10% decline in value, it will be a big blow to your whole belief system and discipline. I have come across a lot of investors in the last 25 years. Every market rise they will invest, and after the decline they will go away and never to come back again, and keep cursing the mutual funds or the markets, which is all right, because the only way to eliminate this possibility is STP. You invest a lump sum in something which is relatively more stable, which will not go down in value, and move your money periodically. Move your money at so that you're able to average your investment. So these three things are as crucial: SIP, the systematic investment plan; the systematic withdrawal plan, the SWP, which is to derive a income from your capital; and STP for your long-term investment, which you should not invest at one go. These are three things which you should always keep in mind, and mutual funds in India have done very well to enable this. And the way SIPs are becoming mainstream, SWP also needs to become mainstream, because there are large number of investors who have never invested in their lifetime, but they need to derive optimal, or they need to enhance or optimize their return from their capital. Those investors, they are not in the accumulation phase, they are not investing, they don't have the time, they have grown old, they have the capital, they need to optimize it. And this is a relatively less known, or relatively less aggressively the awareness created. So investors need to really leverage these two simple things. They sound too simple, but they are fantastic. They are so useful that they can fulfill most of your needs if you are using them appropriately. And this is the need of the hour. The way interest rates are coming down, the kind of convenience and the kind of thing that is possible today. It was not possible to provide these three features earlier, because mid 90s we only had closed-end funds. Mutual fund companies used to launch a fund, raise the money, and keep managing it till its maturity. It was almost like a fixed deposit in a market linked investment. Then came the open-end fund, but then if the banking system was not ready, today we have the computerized banking or the centralized banking which is available. Every time we invest in a mutual fund, it has to go from our bank account only, and the redemption proceeds or any partial withdrawal can only come back in the same bank account. That makes it little secure, that makes it quite secure. The environment that has been created as a result of an integrated banking system, the investments to be made, and even the investments being made by the fund manager, that they are liquid, and they are large markets where the realization for your investments, because when you invest in a fund, when you withdraw it, the ability of a fund manager to withdraw it and pass on that proceeds to you efficiently, it has all become possible. So this is quite empowering. SIP and SWP, if you think of 25 years ago, 30 years, 50 years ago, this was the privilege only of the wealthy people. Today it is possible for everybody who is going to save even 500 rupees a month. So wish you very best, leverage them to the hilt, make use of them, and you will benefit, and you will understand the benefit over a period of time as well.
Thank you, Dhiren. We will now move to the questions and answers for today. First up, Dilip asks if it is possible to start an online SIP with auto debits from his bank account.
Yes, many fund companies actually provide this feature. It is possible to start your SIP. The way it works is you fill up. First thing is that if you are already KYC'd, then it is easier. If your KYC is not done, then it is possible to do your eKYC for investment of less than 50,000 rupees per year in one fund. So if your investment scale is going to be this much, even as an investor who has never invested in mutual fund in the past, it is possible to do it completely paperless way online. The way it works is you choose the fund and give the instruction, put your bank details, validate yourself, provide your email ID and phone number. So these are the mandatory things. Of course, you need your PAN number handy. Then you get a code from the fund company which you have to go to your online banking account, and because in your online banking account, online access to your bank account, you have to give an authorization that whenever this particular instruction, or whenever this particular transaction comes for fetching money from my account, he is authorized to take this much money from my account, at what periodicity and for how long. This information you can put it in your bank account. Whenever you want to discontinue, the way is to go back to the fund company's website and give instruction to discontinue your website, or and at the same time take that instruction out from your online bank account. So you have to, it works as much as like the banking, if you are going to authorize somebody to take that money, so you have to give that authorization in your bank account, which can also be done online.
Extending the same argument further, Dhiren, Pramod says that opening SIPs with different funds can be cumbersome. Is there a centralized platform for investing in them?
Yes, it could be cumbersome, but don't open too many SIP accounts. Have 2, 3, and that will actually, simplifying your investment world is your responsibility. And I think 2, 3 funds of a certain kind will fulfill most investors' need. In fact, having more than 5, 7 funds actually has, reducing benefit in terms of you become a quasi-diversified, quasi-index fund, different strategies at work, you also lose interest. So that's one. The other is that it is possible to have a centralized place. The mutual fund utility is one place where you can set up multiple accounts, multiple SIPs at one place of different fund companies. You also get, you are able to aggregate all your investments at one place. And of course, if you set up your SIP account at different fund companies, that is also not very cumbersome. And the registrars of the mutual fund companies, the CAMS, the Carvey, Sundaram, and Franklin Templeton, it is possible to get a consolidated account statement anytime you want by putting your mail ID. The mail ID which you fill up while making that investment, if you go to CAM's website, or even if you come to Value Research online website, you can put your mail ID, and you will get a consolidated account statement. In fact, a transaction history of all the investments made in your lifetime. And once you have that, I think monitoring it and keeping track of it is not very difficult, because all the inputs in Value Research portfolio happens once you forward that statement to us.
Next up, Gopal Prasad asks how individuals with fluctuating incomes can invest through an SIP.
Uh, don't do SIP, but be very diligent about your investments. And there is another way of dealing with it. If you are sure of your fluctuating income but with a base, so invest in something more conservative. If you have fluctuating interest, it depends on how fluctuating it is. If in 1 month you are able to make a lakh of rupees, and in next 3 months you are not going to make anything, then it is a different story. Then I think those investors should invest that 1 lakh rupee into something more conservative, ultra short term bond fund or a short term bond fund, and give a standing instruction to move that money over a period of time, 3 to 6 months. The other way is that if your fluctuating income is very consistent, then make lump sum investment every month, whatever you are left with, because investing performance is entirely a result of your discipline. And if you are disciplined about it, whenever you have surplus, you are investing it. Even if it is a variable account, it is fine till you are regular with that. So this is your SIP, which is a little less consistent amount being made every month.
This next question has been put up by a viewer in Hindi, Dhiren.
Yeah.
I'll request you to please respond in Hindi for the benefit of this gentleman. This viewer says that कोई म्यूचुअल फंड अच्छा परफॉर्म कर रहा है, ये हम कैसे जानेंगे? ये भी हो सकता है कि सभी फंड हाउस अपने अपने फंड के परफॉर्मेंस को बढ़ा चढ़ाकर बता रहे हों।
बढ़ा चढ़ा के परफॉर्मेंस बताना बड़ा मुश्किल है, क्योंकि जब भी कोई म्यूचुअल फंड कंपनी आपको, एक तो हर एक म्यूचुअल फंड का NAV रोज शाम को कैलकुलेट होता है, उसके कैलकुलेट करने का एक तरीका है, जो भी उस फंड में के पोर्टफोलियो में जो शेयर्स हैं या बॉन्ड्स है, उसका दाम जोड़ा जाता है और कितने कितने यूनिट्स इशू किए गए हैं उसको डिवाइड करके आपका एनएवी कैलकुलेट किया जाता है। जितने नए इन्वेस्टर जिन्होंने अपना पैसा निकाला है, जिन्होंने रिडीम किया है, या नए इन्वेस्टर जिन्होंने पैसा लगाया है, उन्हें उसी दाम पे नए यूनिट्स अलॉट किए जाते हैं। तो अगर कोई फंड कंपनी बढ़ा चढ़ा के बताएगी तो उन्हें पैसा कम, वो ज़्यादा पैसा ले रहे होंगे नए इन्वेस्टर से, जो कि गैर कानूनी है। अगर सेबी के इंस्पेक्शन में अगर ये आएगा, अगर ये पता चलेगा, और इसको बहुत रेगुलरली ऑडिट किया जाता है, तो मुझे लगता है ये जेल जाने वाली गलती होगी, क्योंकि म्यूचुअल फंड का गलत तरीके से कैलकुलेट करना, बढ़ा चढ़ा के बताने का मतलब यही हुआ। तो मुझे नहीं लगता है कि आज तक कभी किसी म्यूचुअल फंड कंपनी में ऐसी गलती पाई गई है। म्यूचुअल फंड कंपनियों से गलती होती है कि उन्होंने कोई ऐसा इन्वेस्टमेंट किया जो कि ख़राब हो गया, जो कि अच्छा परफॉर्म नहीं किया, कुछ ऐसा इन्वेस्टमेंट हुआ जो कि डूब गया, वो कंपनी डूब गई, ऐसा होता है। लेकिन फंड कंपनी अपना नेट एसेट वैल्यू बढ़ा चढ़ा करके बताए, ये संभव नहीं है। और मुझे नहीं लगता है कि इसकी संभावना भी है, क्योंकि ये काफ़ी बड़ी गैरकानूनी हरकत होगी।
Thanks, Hiren. And I'll take this opportunity to inform our viewers that if they are more comfortable with Hindi language, then we are happy to respond to their questions in Hindi. Moving on, Mr. Raju asks what factors he should use to make the decision to exit a fund.
Primarily, there are two reasons. One is that your needs are fulfilled. You invested for a purpose, and your need is, your goal is met. The investment has performed. Take your money out. There is nothing better than a fund invested for a purpose and it achieves it. The other is when the fund does badly. You bought a fund because it was doing well, and the fund over a period of time looks like, if you have to invest in a new fund, or if you have to invest in a fund, the fund which you are investing in no longer has those attributes, the reason why you chose it in the first place. But how do you decide it? You have to see the right numbers. One, the way to look at it could be, a slip on rating consistently. If a fund slips from a 5-star to a 4-star to a 3-star to a 2-star, I would say ask question, figure it out why it has done so. Generally, a relative performance translates into these kind of rating down, slippages. That's one. The other is your, the fund is doing well, but most other funds are doing much better. This you can see, but over what time period? I would say allow a fund at least 2 years, because there has been at least 2 years. Because if you just look at 3 months performance, and if the fund is not doing well, and jumping, taking a decision and jumping from one fund to another may not be a very wise thing. So I would say that when a fund does poorly as compared to similar funds you have invested in over a 2-year period consistently, consider selling it.
Next up, Manoj asks how can he shift from the direct plan of one fund house to the direct plan of another fund house?
You can't do it with great ease. Mutual fund utility might provide you some convenience, but I think the simpler way of doing it is redeem the fund and invest in the new fund.
This next one comes from Naresh. He asks what should be the frequency of reviewing one's mutual fund investments?
I would say, reviewing your investment, you should do it every year. And after the first year, reviewing your portfolio every quarter for big rebalancing opportunities might also be okay, because, once your investments are over a year old, rebalancing becomes very tax efficient, because making some changes depending on if the equity has done very well or if it does poorly, moving your money from fixed income to equity. So for rebalancing, generally an annual review of your investment is good enough, and for rebalancing, taking a look at your asset allocation every 3 months subsequently might be a good thing.
Next up, Malayappan, who is 37 years old, says he has about 2 lakh rupees monthly surplus but he has not saved anything except 10 lakhs in an FD. He wants to know, can you give him a plan of action, Dhiren?
Uh, the plan of action is very straightforward for him. But I'm assuming that he is unlikely to need the money for 5 years and more. And this is the money which will be needed 5 7 years or 10 years down the line, or maybe for his retirement, any such thing. Then the plan of action should be that first he should consider investing 1.5 lakh rupees in a tax saving fund if it saves him tax. That's one. If that is not the need, then 2 lakh rupee should be invested for the first 3 years in a balanced fund every month by way of SIP. Do your SIP in a balanced fund for next 3 years. Never invest lump sum, and after 3 years, move all the money that has been accumulated in balanced fund as well as the new money that you will be investing thereafter into a multi-cap fund. This is important. Balanced fund and SIP is important because for somebody who has never invested in the past, who has only an FD, it is important that you onboard or you start your investment life in a manner which is not scary. And the kind of market we are in the middle of, or markets are always like this. uh, Markets are always scary in the short run. So it is important that you calibrate your participation, your entry in a manner which is confidence inspiring, in a vehicle which is not extremely volatile. And 3 years from now, move your money from fixed and the balanced funds to a multi-cap fund. And so choose two balanced fund and start investing a lakh of rupees in each.
This next one is something I'm sure a lot of our viewers would have on top of their mind, Dhiren. Sanjeev asks, how safe is electronic money with fund houses in the light of recent ransomware attack?
Mutual fund investments are relatively safe in a sense that mutual funds are actually not, you put your money, you move your money from your bank account to the mutual fund. The mutual fund buys the security and gives the money to a broker and takes ownership of that security. That security lies with a custodian, which is in the name of the fund. So in that sense, this is reasonable. So somebody has to, uh, hacks can happen at different level, but I really wonder that till every investor should keep track of his bank account, the evidence of your money moving to the fund company. That's the evidence that you have. That is a bank entry. That this on this date you invested this much money in and where. Uh, I can't think of, and the other degree of safety is that all the money that you invest in a mutual fund must necessarily go from your bank account, and all the redemption proceeds or any kind of partial withdrawal should also come necessarily in that bank account. Nobody can redeem my investment, and he can't, anybody else cannot get the money in his bank account. So somebody cannot really get a check of my investment proceeds. So these are reasonably secure things. I think an investor should worry about these ransomware and malware for their own bank account, because if somebody is able to get hold of your email account and your bank account uh, as a result of that, then your investment is at risk and you have to protect it yourself, because that person who has stolen your identity for validation will access your bank account, will access your mail account, as a result of which he can access your investment account, redeem those investments, which will come to your bank account and steal the money from there. So it is every individual's responsibility to make sure that he makes himself aware of it, behaves in a manner that which is safe, digital practice, put some kind of authentication. Even for your Gmail account, you can actually take out, you can have a two-factor authentication, have that Google authenticator on your smartphone, so that if accidentally you are using your Gmail account somewhere else, you normally the default is that you save your password and access for use in that browser. So you will have to take a lot of precautions. There are great benefits of going digital and being online, and these are hazards of being online. You have to act responsibly. all improvements comes with their set of risks, and you should really learn how to deal with it, and guard yourself against the pitfalls.
Moving on, Rahul asks if it is fine to confine his fund universe to only 5-star funds.
It's not a bad idea, but definitely, 5-star funds can actually make a set of 5-star funds can make a good starting point. That should be a good universe. But more importantly, even before you get on to rating, the starting point should be which is the most appropriate kind of fund for you. If you are a first time investor, why invest in a tax saving fund or a balanced fund? If you have invested for a long time, you are used to ups and downs of the market, which is the kind of fund which you should be investing in, for what time frame? If you are investing for the short run or the medium term, what is the appropriate category? So choosing that category is very important. Then comes rating. Yes, 5-star funds actually are the is a selection of relatively superior, demonstrated superior risk adjusted performance. So it could be a great starting point.
This next one comes from Sagar. He wants to know what type of funds he should select for a time horizon of 1 to 1.5 years.
uh, Ultra short term debt fund and short term debt fund at most, and don't err on the side of caution. Don't go by the best performing funds in these categories. The best performing funds can actually hide something, which is the risk, and the risk does not visit in debt funds often, but whenever it does, it actually hits the performance of the debt fund. So check for another thing, how much is the allocation to the lower rated papers, because lower rated papers, once in a while they go bad, and when they go bad, they are not a huge risk to the fund. The real risk is the investor's behavior. When if there is a large fund, and assuming that there's a 1,000 crore fund, and 1.5% is invested in a paper, is invested in a lower rated paper which fails, or it defaults or delays, or some kind of a non timely payment of interest or capital. In that situation, the loss to the fund is only 1.5%. But unfortunately, many investors get scared, and a lot of investors turn up to take their money out. When a lot of investors turn up to take the money out, actually the fund gets distracted. The fund actually takes a hit because the fund is forced to sell a lot of securities in a fire sale, and so the fund actually gets destabilized. So this is actually a bigger risk for fixed income investors. The behavior of other investors in bad times, or when you meet with when the fund meets with a small accident, it turns out to be a larger accident because of the behavior of the other investors. So steer clear of any fund which has any large allocation to any allocation, meaningful allocation to a extremely lower rated paper which is used to enhance the return.
This next one comes from Supratim. He asks which is a better form of investment, gold coins or gold ETFs, looking at a 5 to 10 year horizon.
Neither. In fact, if you have to necessarily invest, in fact, gold is not a great investment, but if you have to necessarily invest in gold to ride the rise in prices of gold which you visualize, then you should buy the sovereign gold bonds. They are the best. They actually give you an exposure to gold. They give you exposure in a paper form, and it earns 4% more. All other forms of gold holding comes with a cost. When it comes to gold coins, you will have to preserve it, and you may not be able to realize the full value when you want to sell it. Buying gold coin is easy. Selling gold coin at the same price is not easy. Likewise, gold ETF, it comes with a 1.5% cost, annual cost, which is the cost of running an ETF, and over and above the brokerage and placing an order. A gold fund, which in turn invests in a gold ETF, also comes with a 2% cost, or maybe 1.5% cost. So in all these forms, all these investments, you will earn little lower than gold prices. Only the sovereign gold fund will actually give you the gold price plus 4% return, which is quite meaningful.
Thanks, Hiren.
Thank you.
That's all we had time for in today's session. Any parting advice for our viewers today?
Yes, you would have heard of SIP and SWP, and you might be taking it as a very simple thing offered by all fund companies. So there is nothing great about it. I think it is a great enabler. It has democratized it is very empowering. It has enhanced our ability to turn something small into very big, or derive a very steady flow of capital. So, appreciating this, and this is something which was not possible 15 years back, 20 years back. This was something which was for the privileged. So, enjoy this. It's almost like telephone. What used to be the privilege of the wealthy, this has actually democratized your ability to get wealthy with your small savings. So you take it seriously, use it immediately, and be uh, leverage it as much as you can, and don't complicate things. These are very simple enabler and are very powerful ones. If you haven't used it, start using it right away.
Thank you, Dhiren.
Thank you.
And thanks everyone for joining in. Do join us next week as well for another session of Money Hangouts.